Good afternoon. I'm Chris Swift. Welcome to this edition of Shooting the Bull. We got a lot to go over today, and I've been really dealing with a perplexed situation of inflation versus recession. We have heard all of the news comments and a lot of the market participants out there discuss the difference between the inflation and recession and which way is our economy going to go from here. So we're going to take a few minutes this afternoon and discuss some of the reasons why I think we might lean a little bit more towards recession now than inflation. We went to Las Vegas earlier this year, and we learned a lot. The analysts there were looking at the larger crop size from Brazil, maybe a little bit reduction in the conflict between Russia and the Ukraine, and clearly better planting perspectives for here in the United States. It kind of led to a negative feeling. We came back and we really wanted to kind of be short in markets, some corn and beans. The Fed had been raising rates aggressively, and the economy was starting to slow down. We were starting to begin to see some of those actions that the Fed had done to really impact some spending. And as we go forward, we'll notice that what it probably did more than anything is it impacted industry. So these factors are what kind of help lay down the foundation of what we're going to discuss today. So we came back from the trip that we had in Las Vegas. We looked at the markets and we started being aggressive in marketing corn and beans. The markets went down just a little bit in the end of January, 1st of February, and then right around the mid-February, they began to rally a little bit. And then March, they all just sold straight off. Corn sold off, energy sold off, multiple markets sold off, and the bond market rallied during that time frame. Then we came and after that, the markets kind of disassociated from themselves. They all went different directions. The corn market, the new crop corn stayed lower. The old crop corn rallied a little bit. We had a significant divergence in the energy markets, for which we saw crude oil and gasoline move sharply higher and diesel fuel stay right exactly where it was. So believing that the energy markets and the bond market have some ideas to what the economic aspects are to be, I'm watching them a little bit more closely. So if you've been reading what I've been writing last couple of weeks, you've seen I've gone back and forth between whether I think more inflation is going to be prominent or more recession is going to be prominent. And I guess last Thursday, I kind of had the feeling after seeing everything go down, I said one of two things. I'm either dead wrong or this is the pullback before they shot up. So I gave it Friday, Monday. The markets continued to go lower. Even to today, they're really pushing lower now. So I changed my mind around Monday, Tuesday that I needed to be back towards a recessionary aspect. I made some recommendations yesterday on how I wanted to approach that. And so kind of push forward from there and see what we did. So in the corn market, this is the new crop corn. We can clearly see that from the B wave, right at the 1st of February, the end of February, 1st of March, we sold off pretty sharply and then just plateaued. When we look at the close only chart on the same December, we can already see we're closing lower now. And this is actually already lower than this point back in July of 22. We look at the energy markets and we can see very similar chart patterns from that same June of 22 timeframe down to the March low. We can see the March sell-off in the crude oil, and then becomes the differences. Then you get the big rally in the crude oil, and that began to change some of the aspects. And for a while, I really believed that we might be more inflationary for a time frame. Then started delving between the difference between the three. And what I believe is that gasoline is the energy source of the consumer. It is what people ride around in cars in and get from point A to point B. Diesel fuel is the energy of industry and manufacturing. And it has been going down ever since that June of 22 high that we made. And it hasn't even had any kind of rebound. And when we saw that March rally in both crude oil and gasoline, the diesel fuel didn't participate in it at all. So the divergence became very confusing while one wasn't reacting as the way the others were, but then having to denote it with, we had an OPEC production cut that really bolstered the crude oil market after it already rallied close to $9. And then simultaneously right in with spring break. So we had spring break, we had OPEC cutting, and it just created that flurry of activity in the March timeframe. So what we think this means is that manufacturing, distribution, and freights of everything, trucking, airlines, railroads, and shipping, all are lower, and all have been showing lower when you look at the numbers of those industries there. So we probably, if we think about the series of events that when manufacturing, distribution all slows down, we begin to lay people off. As we begin to lay people off, then that begins to impact the gasoline market, and then the combination of the two, the crude oil market. So I'm going to go through each one of these real quick. And the crude oil, we can clearly see that I think the wave count now from the June of 22 high to the March of 23 low is pretty much set. And then we have this, what's an X wave right now. And I only put it that there because I don't know what it is just yet. And until I can figure out what it is, it will just stay the X wave. As we see, we got the same thing in the gasoline market. We have the X wave already starting to break to new lows in the gasoline market. And then we look at diesel fuel, and here is that same time frame in March when everything rallied sharply, but not, excuse me, this time frame right here where everything rallied sharply, but not the diesel fuel. Today, diesel fuel is at a new low from that June of 22 high. So it's fairly obvious to see that diesel fuel is the weakest of the three energy sources. And as we need energy to be able to build things, manufacture things, move things from point A to B, there's not as much of that going on right now. So what's next? Seemingly, a resumption of the downtrend in diesel fuel would suggest industry's weakening. I saw reports today that already reflect that. I've listened to Scott Shellady talk quite a bit, and listening to him, it's almost like preaching to the choir because he and I think alike. Whether that's good, bad, or ugly, I don't really know yet. But I'm not the only one thinking of this. And what makes it so confusing is that it's relatively easy to draw out the sequences of events. We have a weaker industry. We see employment begin to suffer from that. And then we begin to see the consumer suffer. But we've yet to see the consumer suffer yet. We've noticed that in beef consumption, beef prices. We've noticed that in other markets, the gasoline market shooting up. And then we look over and we look at all of that new increase of credit card debt. And Scott may have made the best point today is that the consumer is still in a big habit of spending, but yet doesn't know that he's broke yet. So it may take a little bit of time still yet before we see some huge recessionary factors come into the market. But I believe the recognition of it beginning today might help people, business people of every kind, move in a direction that either avoids the recession, helps to mitigate it just a little bit, or actually takes advantage of it. The bonds, notes, the interest rates all hit bottom back in the very first of the year. They have done nothing but gone up and down and up and down. And right now, they're just closer to the upper side of the range than the lower, meaning a little bit lower retail rates and the likelihood of further stimulation needed. Now, we got a big question coming up in May. Does the Fed increase rates or do they not? I'm proposed to say I really don't know just yet, but I think if they continue with it, either way, if they say that they're going to raise rates, it creates an even more recessionary time frame as we're just pulling more money out, and there could be a greater need to stimulate the market. Hence, bonds go up. If they don't raise rates, it might be the signal that the Fed says, hey, we've done too much too fast. Let's give it a little bit of time. That in itself would suggest maybe we do need further stimulation. So actually, either way, I think whatever they do, if they do raise rates, it probably puts the force down so hard that the economy does stop cold in its track. If they don't, it's already sending signals potentially that they have done too much or have done enough, and therefore the markets need more stimulus. So here's the bond market. We can clearly see the bottom, October, November of last year. Then we had the big ABC up and down there. But now we're trading back up at the top end of the range. Today, we're down a little bit lower, but we had 2 big days up. You corrected a little bit today. You've got next week to come in with the Fed meeting. I look for the bond market to continue to be supported with that wave 2 low right around the 128 area, 129 area is being good support for the market right now. So the combination of interest rates and energies are pretty good when we're looking at what should or what could happen into the future. And right now we're seeing energy prices considerably lower, especially today, and in some cases have begun to break lower in the diesel fuel. We've seen bonds kind of perk back up just a little bit, and the note markets are a little bit higher from the last couple of days. So maybe we're just seeing the very turn of what these events are going to lead to. So what are we going to do? We're going to keep watching for energy to resume the downtrends. I think that's already happened today. I wrote this last night, so we've already seen further follow through. Grains have already begun to resume their downtrends, and clearly we saw beans and corn make headway, and wheat. And of all things that we think nothing can happen bad to the cattle market because of the supply situation, we look at wheat and we go, it was planted in a drought. It remained in a drought for the majority of the time frame. It got frost and frozen on, and in one of the most critical stages of it, the crop progress report reflected that, and wheat's down 40 cents from that point. So the best laid plans can always be circumvented in some way. Bonds and notes at new highs would spur further attention to this. With this analysis, I'm going to continue recommending market fat cattle with put options only, and buy the at the money. It gives you the greatest probability, regardless of how far out time you got. And although it may be the worst thing that you've ever spent money on when it comes time to sell those cattle in October, and they're $10, $15, $20 higher, that's okay. There's nothing going to be wrong with protecting something that you know you should. And I will label that the same way as I tell everybody in their car insurance. How many people at the end of a 3 or 6 month time frame of their car insurance start cussing because they didn't have a wreck and they didn't get to use that insurance money? So we think of these things and say, well, we don't want to spend these things. But in all honesty, nobody wakes up in the morning and says, I'm going to go out and wreck my car. 9 times out of 10, somebody else hits you out of the blue, and you're thankful that you have that insurance. Probably the same way, because clearly we see the cattle market going up, new highs today in the feeder cattle and close to it in the fat cattle market. So whether the top is in or not, I really don't know. But every time that it goes higher, we have to believe that somewhere out there, a person gets priced out of the market, whether that be a consumer at the retail market, a cattle packer, a cattle buyer, whatever that may be. The higher the price goes, the more you push people out of the way. With the feeder cattle market, I think the fence option is still the way to go. At your worst case scenario, you'll still be selling cattle at the tip top. You may not have made all the way to the tip top, but you will have made considerable premium for which right now is not available to you. The cash index, the feeder cattle index, has not been able to come up to the same levels as what the futures. Now we see the April contract meeting at the little bit lower end of the spectrum from the index, from the futures, and on the index is right at the tip top right now, but we're still $4 or $5 now off the high of that. So I still think that staying in this, regardless, when the fall gets here, if that market is higher, you will have still made the spread between the two a predetermined amount. And again, I doubt very seriously that you are going to sit there and complain a lot saying, gosh, I wish I'd have gotten to use that insurance premium that I had paid for, and the price had dropped down and I made lots of money off the futures market. That just means you lost money or didn't make money off the cash side of it. You want this market to continue higher, regardless of whether you're hedged or not, because when it goes down, every day that you have purchased something for your operation, you probably purchased it at the high. So if we start down from here, it's going to be very difficult to repay some of those. So the last thing I'll show you here, here's the October contract of the fat market. Potentially you've got 1, 2, 3, 4, 5 waves up. We've already seen the oscillator start to tip over. We've seen the price tip over. It's not going to surprise me that this is just another correction and off to the races we go again. I just don't know. The feeder cattle market, kind of the same way. Here, we can see the spreads that we have in the feeder market between the feeder cattle index and the futures. And I've just posted that current historical high at 245.20 up there to show you where we are right here, where the market is down there, and where the index is from that historical high. So we've still got a lot of risk in that market, regardless of whether it goes higher or lower. We're dealing with a tremendous amount of capital out there. So this is what I want to wrap it up with, as a point of interest. And I went back into some of my writings in early of 22. There were already aspects that the crop was going to be lower. We had lower acres planted. The weather was not good. We were still in a significant drought. And we were in a really big point of time in our inflationary aspect. The price was going up. And I told myself and I told clients, and I wrote this, I said, although the price is going up now and we need to be protective of it, we need to make sure that by 23, the May, June, and July timeframe of 23, when the corn will be the shortest, regardless of how short the crop is in December, it's the shortest now. So we look back and we go, even in the knowledge of how fewer acres, and today the proof that we had fewer acres and fewer and lesser yield out there, and yet we haven't set a new contract high since June of 22. So again, the best laid plans can be circumvented, and that's why I'm a little bit more cautious about the cattle than just saying, let's just see how high they go. Seeing how high they go might lead me to not protect what needs to be protected. And again, just the sheer amount of capital out there, the enormous profits that I know some people are making today because the price has already risen, yet cattle placed today or put on grass, pasture, whatever, are being placed at the highest. So therefore, in the future, it has to be even higher. So just kind of look at that chart, know that we had a really, really short crop in 22, and that by 23, it's going to be at the shortest, which it is right now, and yet price has not gone up to reflect that. So let's take that with a grain of salt. We'll finish up today by telling you that if you need some help, if you get confused, Chris Wimber, myself, and Sean Gammon are here all the time, or can be reached on our cell phones. This is our living. This is our business. We want to make sure that we're available for you when you need the help. Give us a ring, send us an email, shoot us a text, whatever, and we'll be glad to help you any way that we possibly can. Thanks for taking the time to listen. Give us a ring if you need something.